Balaleli Makaya. Once again, welcome to the Den Radio. We have Mr. Mabuza on the line here. I don't want to spoil his huge introduction. I think it's better that he introduces himself. We did send a bio, which actually qualifies why he is the right candidate to treat the topic that we have and to sum up our financial month. Mr. Mabuza, welcome to the Gen Radio.
Well, thank you very much, Mr. Kamwile. It's an honor truly to be invited this evening to be part of the show. Thank you and the whole staff at the Den Radio for making this possible. I'm sure we are going to have a great time. Yeah. And also welcome to everybody who has joined. I'm sure that it will not be time that you wasted, but it will be time that is well spent. And so I'm looking forward to just sharing some knowledge with you, and then maybe a few interactions at the end. As I understand, it's the norm in the show. Yeah.
Amen. We can just go straight to the show, Mr. Mabuza. I'll hand over to you that you can share your lesson, and then I'll come back once you are done, so that we tackle whatever question our listeners have sent through.
Okay, perfect. Thank you very much. And so, yeah, I won't take much time. Without further ado, we'll dive right into it. But I think you did mention that you did send the bio out, so many people have read it. But I live in Pretoria. I'm an engineering graduate from the University of the Witwatersrand some many years ago. And I've been mainly working in the mining industry and technical industry, doing as an engineer and later on managing projects. So that's the space that I'm in, and I also do advisory work for some companies as well. And so that's the space that we are working in professionally. It's also a passion of mine to teach whatever knowledge that I've acquired, through the years, through experience, through learning from other people. I'm a strong believer in passing knowledge to other people as well, because we need to all be better off at the end of the day. And so it's something that I do with a great deal of passion. I'm a kingdom citizen, and so I'm very much in line with the principles of the kingdom of heaven. And I'm glad that we can talk about some of the things in this show tonight. So welcome everybody, and thank you for tuning in. I'm sure maybe other people will still join us along the way, and that they will also just catch the wave. Before we continue, I'd like to just pray with us so that the Lord will guide us, and that more importantly, that He will be the one that teach you wherever you are. Some people may be tuned in from different parts of the world. You are most welcome. And so let's pray. Father, we thank you in the name of Jesus, even for this time that you've given us to be in your presence. We don't take it lightly, Lord, that it is you who gives us the energy and the power and the knowledge and the resources to be able to do what we do. And so we're grateful, Lord, for this opportunity. And for everybody that has tuned in tonight, I pray, Lord, that your grace will be upon them, and that, Father, you will speak to them from your heart, Lord God, and that it is you who will teach them. Holy Spirit, as I speak the words, you will minister to every person according to their needs. And that, Father, you will awaken them into whatever it is that you have for them tonight, and whatever it is that they need to learn. I thank you and I bless you. Thank you for this platform, and for this, that it may continue to grow. I pray your blessing upon the founders and everybody who is in the running of this machinery, that it will be a blessing even to many nations and to many people. I thank you, Lord, in the mighty name of Jesus Christ. Guide us as we do this talk tonight, in Jesus' name. Amen. And so, yes, I would like to, it's in the context of the financial month, and great wisdom has been shared over the past few sessions in this regard. And then discussions about budgeting and so on have been held. Some of you may have tuned in, some of you may not have. But so tonight I would like to just sum it up and just help us with some knowledge that maybe not all of us are usually exposed to. And so I'd like to just dive into that. And that's mainly on the side of wealth preservation. I would like to talk to tonight about wealth preservation. And I will be talking specifically around structuring of trusts and around that topic, because I know that is something that is extremely important, but that few people have a knowledge of. It's a tool that many rich people around the world use, and it can be beneficial for everybody, and it's important that we all gain some understanding into it. I know some of the things I will say are a little bit deep, and they require a great deal of additional research, and I encourage you to, after this session, to go and look for yourself in terms of the detail, but I will touch on the important aspects of this topic, so that at least, if nothing more, you get some kind of awakening, and for you to realize that there's a better way of doing things, and how you can actually pass on the things that you work hard for, even to the next generation. So I'm talking tonight about using trust to preserve and to pass on your wealth to the next generations to come. Not just generation, but generations to come. Before we continue, I'd like to start with just a few reminders for us. One, importantly, that relates to this topic, being a scripture in the book of Proverbs, chapter 13, verse 22. And it reads thus: it says, "A good man leaves an inheritance to his children's children, but the wealth of the sinner is stored up for the righteous." And these are words that were spoken by King Solomon, the wisest king that has ever lived, probably the wealthiest as well. He says, "A good man leaves an inheritance to his children's children, but the wealth of a sinner is stored up for the righteous." So in other words, if you proclaim to be good, we see your goodness in you passing an inheritance to not only your children, but something that will last and benefit your grandchildren as well. These are the ways that were spoken by a very, very wise man, somebody who's been given wisdom by God himself. And so it's important for us to be mindful of that, especially when we talk in the kingdom systems. That is it's extremely important. And so I know that some things have been taught before, but I just want to share some things that maybe may seem obvious, but may not be that obvious to everyone. So first of all, for you to pass on wealth to the next generation, you first have to become wealthy yourself. And so how do you become wealthy? Number one is that you need to make more money. In order to get wealthy, you need to make more money. I think it's a bit obvious, but it may not be that obvious. So in other words, you don't create wealth by saving, and that might seem contradictory maybe to some things that we hear every day. There's nothing wrong with saving, but when you save, you can only save the thing that you already have. And if you're not doing anything with that saving, that it's probably gonna get eroded over time, because you do get increase on the cost of goods and so on, and so that erodes that saving that you have kept for yourself. So you become wealthy by making more money. In other words, you need to have strategies to make more money, get more streams of income, and get more money into your pocket through whatever means that you can, or that you can master. Secondly, you need to protect your money. So it's no use making money and then you do not protect it. And this bullet point is the area in which we are talking about tonight. Number three is that you then need to budget your money. So it's important that you look at these things in these steps. So although you can act on them, in a mixed up fashion, because you do all of them probably at the same time, but it's important for us to just take cognizance of this, that you then need to budget your money. In other words, you need to plan where and how you are going to spend your money. It must not be haphazard, because you are going to become wasteful in terms of that. We were talking just with a friend of mine this afternoon about some mishap that happened in a bank account. That there is a debit order that is supposed to be paying for something very important, and it has not been going through for the past couple of months. But they also have not taken the responsibility to check that debit order is going through, and as a result, they then found out 6 months later that they have not been paying their mortgage. And so you can understand that's a very. But I'm using that just as an example, because we laughed about it and said, well, so you always thought that you had extra money for this past few months because you just seem to have more and you didn't know where it was coming from. And so we always just get to spending it and then realize later, oh my goodness, I've actually been eating my own house, or I've been eating my own car, you know? So yeah, it's just a chuckle, but yes, these things happen in real life. So number four is that you need to then leverage your money. So you need to make your money work harder for you while you work less harder as you continue to grow in making more money. So you have strategies, so you have protected it, you have budgeted it. You need to make more money work for you harder by investing it, of course. That's how you leverage it. And then number last but not least is that you need to improve your financial information or financial education. So you continue to learn new rules of how you can apply them to make yourself more, astute in making more money. Like for example, now there are all sorts of different cryptocurrencies and other things that people do. So those are different things that happen and change with time, and we need to be tuned in with the times to be able to catch up and be able to make more money. So the more we don't learn, so we get to miss out on these opportunities that come to us. Some few very critical ways that I usually share in every opportunity I get to speak about finances is how people perceive some risks. So here I have some slow ways and fast ways in terms of things that you do that can get you to a certain place, but how you can get there faster. So for example, a slow way would be if you want to get more money, so you're always looking for a higher paying job, it's a good thing to do that, but a faster way to do it is to look at cash flow. So you want to look at cash flow rather than a higher paying job. What do I mean by that? If a person earns 100,000 rand and then all their bills add up to 90,000 rand, so they only have 10,000 cash that they can actually use to do more useful things because they're spending the rest on just their living expenses. Another person may be earning 50,000 rand, but they spend 30,000 rand on their expenses. So they have twice as much money to get them to a better place in terms of investment. Both people will still be owning a house and also driving a car. The difference is what size of house and how expensive it is, and what size of car and how expensive it is. But bottom line is that they're all sheltered and they are driving around. But the other one has got more money to invest than the other one. So the higher income does not necessarily mean that you can do better. I hope that makes sense to you. The second way is you save money. It's a slow way to save money. The first way is to make money. I've already explained that one. Another slow way is to avoid risk. In other words, you say, I don't want to get into risky situations because I'm going to lose stuff. Okay, so you trade more carefully, which is a good thing. There's nothing wrong with it. But a faster way to get there is to actually gain control. So you gain control of the risk. An example of this is driving a car. You can a certain driver can drive a car which is rated at 250 kilometers per hour, but they can only drive it at 80 because that's how comfortable they are and how much they are trained to do it. A trained driver like Michael Schumacher, I think I'll use that name because people know that one better. They can drive a car at 300 kilometers per hour and not overturn it, but it's still the same thing. The difference is the skill of the person. Another way, slow way, is to pay retail. In other words, you buy your things from Edgar's, from all these retail shops. You pay of jeans, you pay 800 rand, and so on and so forth. And a faster way is to buy wholesale. So you buy where things are made. It's the same thing, but you buy it for less, and so you can get more of that stuff. The next one is slow way is to buy shares. So you buy shares on companies, but faster ways is to sell shares. In other words, you create companies that then sells the shares to other people. The last one and my favorite is to slower way of getting there is to go to school. So you go and spend 7 years on a career studying this and this and this. Nothing wrong with it, but faster ways is to go to seminars, a seminar like this one, because it gets you to a destination faster. You learn something today and you use it today. I see already my time is already a challenge before I get into the topic of the day. But let me do this because it's very, very important. So in terms of how you should spend your income, and this is extremely important as a kingdom citizen or anyone for that matter, because it determines where your trust is and where you feel that you get the power to obtain your wealth. The Bible says to us that we must honor the Lord because he is the one who gives us the power to obtain wealth. And so in your budgeting, whatever you do, make sure that you at least have these components in it. First of all is that number one on the list is to pay your tithe. The tithe is 10% of your income. Give that to God, because it tells God that you honor Him with everything that you do, because He opens opportunities for. I'm not teaching on this today, so I'm not going to expand on that. The next line must be giving. So you give to other people, whatever, in whatever way. Another 10% you spend it on that. Okay, very, very important. These top two things. The first one being the most important, because if you don't do that, you basically cut your lifeline. The third line being to try and invest at least 10% of your income. Don't eat up everything. 10% you invest it, and make sure that your living expenses are not more than 70%. I have another colleague of mine that I got to meet through his experiences and what he has learned in life. He said, look, I make sure that I live on only 50% of what I get, of the net income that I get. I only spend 50% on my personal expenses. The other 50%, I make sure that I put it away and I invest it, because I have learned that I can have a job today or income today, and tomorrow I have nothing. I think all of us have learned that lesson during this COVID period. I don't need to really hammer on that. So in other words, he's buying himself a year for every year that he works. If he works for 2 years, then he's got money that he can last him another 2 years. I hope it's a simple principle for us to understand, and it can really help us in the times that the world is currently going through. An extremely important lesson for us to look at. And so I want to talk to us today about passing on or preserving this wealth. So assuming that you are working hard and you are budgeting your money, you are doing everything, and then you are investing, you are trying to make sure that things are taken care of. But then you need to then have a system, first of all, that preserves your wealth. Preserve it for yourself. In other words, that people cannot come and steal it. If you make a mistake at a certain type or point in your life, that you don't then lose everything. That's what it is for. And or secondly, that you can then pass on that wealth to the next generation in the most trouble-free manner. And that's what trusts do. So understanding trusts is the next part of our discussion. Mr. Gamule, how much time do I have to talk before I continue just babbling further? I need to pace myself and make sure that I still deliver, quality information that people can actually understand. Let's talk about that quickly. That guidance, yeah.
Yeah, we still have about 40 to 45 minutes.
For me to talk.
Yes.
Before questions and answers.
Yes.
Okay.
Yes.
So I don't need to rush it that much. Okay. Thank you very much for that guidance, because I really want to bring this home. And so before I even carry on with this, I think I need to say that I think, it's a discussion that we've also been having in our close circles with some of our close people, that you know what, I think this COVID, if anything, it should have taught us some great lessons, all of us, that you might think you have something today and you've got a good grasp on it, and tomorrow you might wake up and some event just hits you, and before you know it, you have lost everything, especially if your income is all spent in your expenses, and you are working on a job, so you get hit by COVID, or you've got a business that is running well, it gets hit by something like COVID, and the next day you wake up, it's on a lockdown, you can't operate your business, your job gets closed down, and then before you know it, you get retrenched, and then you have all these expenses, it's your house, it's your car, and all these things, and then you start stressing, and before you know it, the banks are knocking at your door, they give you that 3 months relief, and then after that it's gone. And then they are coming for their money. And before you know it, you have nothing left. And so I just want to challenge you, and this is a challenge that I'm putting to everybody. And I'm telling you that it is possible to do it. That why don't you consider actually living your life completely debt-free? I know that for many of you, it's a shocker, because you have never even conceived it in your mind or even thought that it was possible. Well, I'm telling you that it is possible, that you can be in a position where you don't owe your house, where you don't owe your car, where you don't owe basically anything, and any income that you get is a positive that you can spend towards, whether it's at least pay for children's education, and really live a much, much stress-free life. It's a possibility and a challenge that I'm putting out to you, all of you who have tuned in today, and hopefully that you can take it away and begin to work on it after this program. There are many other discussions we can have in another time of how to, fast track your bond payments, because I know some of you think that How is it possible that I can have a house that I don't owe? I don't owe anyone. I'm telling you, this is possible. I know that, a few years ago, at a church that I used to go to in Woodbank. It's a church that is very close to my heart. At Gateway Church International, I must mention it. The pastors, started preaching on a certain message, and we all clubbed in. We looked at it and the credibility of it, and most of us, started on engaging on a project to build our own houses, debt free, and the people that tuned in to the message of the time actually went on and did that, build their own houses. It takes a bit of time, it takes a bit of perseverance, it takes a lot of discipline to do it, a lot of denying yourself certain things. Some people, it will take you 12 months, another one, depending on what you do, it can take you 2 years. I know a couple that built their house for 5 years, for 5 long years. At some point, it was standing for a period of 6 months, before they put the next phase of the house. But guess what? After 5 years, they finished that house and they proudly moved into it and they live in it today. It's completely debt free. So sometimes the things that we rush into to say we want the results now, it works to our detriment in the long run. So I'm putting out this challenge to you and say that it is possible that you can do that. Not to talk more about cars, because some of you know that you get a mortgage for a house and you pay it for 20 years. Why can't you, whereas you pay your car for 5 years, for example? So that tells you that you can pay your house for 5 years as well and finish it, and that you can also actually put away money to pay for your car cash. Just do me a favor and go and look at your when they do send you that statement or actually request it, of your car payments, and check how much interest you are paying on that loan that you have asked for that car. The result will shock you, and you will realize that if you just do things differently a bit, maybe some of you have a house, a car. I know I'm spending a little bit of time on this, but I feel that I need to. Maybe it's very important for some of you who have tuned in today, that you have a car which maybe is left with 1 year, to finish paying. I encourage you to continue to pay that car and finish paying for it. If you bought it as a new car, after 5 years, it will still be a great car. And then it can actually drive for the next 5 years after that. And take the same money, if not more, because if you get an increase on your job, then you would have bought a bigger car. Just deny yourself for a little bit. Take that same money that you were paying for the car and put it into an investment account somewhere for the next 5 years. Okay, let me make it 5 years. So, in other words, you are buying yourself another car for the 5 years, which you don't drive, because you are still driving your old car. Guess what? After that 5 years, you would have accumulated enough money that would have paid your car off and the interest that you would have paid. So, if you were buying a car for 300,000, you might find that at the end of the 5 years, you are paying 450,000 rand, for example. So that's the money you have. You can then take that money and buy yourself a car cash, which may sometimes even cost less than that money. And then you continue to save the same money. I hope you get the concept of what I'm talking about. And then as you continue to apply the same principle in every aspect of your life, it will help you to gain control of the things that you do and find yourself in a much better position as an individual, and that you can have a better way to control your finances and have something tangible that you can pass on to the future. And you can then take that money and start buying properties and so on and so forth. At least you know that your primary residence, your cars, your immediate needs are taken care of, and you never need to worry about that a single day further in your life. So it's a challenge that I'm putting out to you. I hope that many of you will accept it and begin to act on it, because it's something that will help you greatly. Right, coming back to the topic of the day, understanding trusts. And I'll just talk about this because I know that many people are not in the line of actually using these kind of structures. So what is a trust? So let me start with this, Tiffany. So a trust basically is a contract, right? It's a contract that is made between the founder of the trust and the trustees that are there then that administrate the trust. And it's a contract that is made between the founder and the trustees. And its main purpose of the trustees is to manage the assets of the trust for the benefit of the beneficiaries. And I will explain this as we continue. It will make more sense to you. So the value of the trust, therefore, lies in the wording of the trust. I think you need to get this very, very clear. The value of the trust lies more in the wording of what are the clauses say that are in that contract, and the trust deed and the way that is written and the way that it is administrated. So two things: the wording in the trust as well as how it is administrated. Those are the things that are most important in the trust. But it's simply a contract between the founder and the trustees that run it. There are different types of trust, two main ones, which then can be, rolled out into many different types inside. But the first one really is called an inter vivo trust. In other words, it's a living trust. It's a trust that a person register and administrate in their lifetime for their own benefit and for the benefit of those that they nominate to be beneficiaries in that trust. Okay, so it's a living trust because you do it while you are still alive. You also benefit from it along with the other people that you put in there. The other type of trust is called a testamentary trust. A testamentary trust is a trust that you can create, but it's not registered and active now. It only becomes active when you die. So when you die, you say there's like in a will to say, I want these things to be done this way, these benefits to be to this beneficiary, and so on and so forth. So you write all of that and you found that trust, but it only kicks in when you die. It's called a testamentary trust. So these are but inside, in terms of how they are weighted and so on, so you can have a lot of different types of trusts from there. But the issue is that it needs to be very private, because you don't want anyone I know that there are many trusts which are written in the family's names and so on and so forth, but it's not something that we encourage. You need to make it private so that the name does not necessarily associate with you, especially if you are going to do a lot of things in the trust and you run a lot of businesses and so on. You don't necessarily want the name of the trust to be associated with you directly. Call it anything, it can be the Grand Family Trust, or or whatever the name that you can, the Tree Family Trust, whatever the name you can come out. But try to make it not, it's not a prestigious thing necessarily for you to be in your name, except for people who have made a lot of money and they want to make a statement, to say, this is our trust that we do certain things with, okay? But if you just want to do it for yourself, it's better for you to make it private. So trusts are formed in this way, in that they must be legally registered with the master and the parties. The master is a master in the legal system. Okay, so they are registered with them. For different countries, they may call them different names. I'm not sure. You can find out in your own country what that is and how they are registered. And the parties in the trust are three fold. It's a founder, which is the person that actually starts and founds the trust. It's called the founder. Secondly, it's got trustees. The trustees are people that are nominated to administer the trust. Okay, so the founder then, together with other trustees, they then administer the trust. They are called the trustees, these people. And then thirdly is the beneficiaries. The beneficiaries are the people that then benefit from this trust. They are named in the trust in terms of who can benefit, not just anyone. You must be named inside the trust. Let me just go and break it down a little bit more in terms of the parties to the trust. First of all, the founder. So it is advised that you become the founder of the trust. It's not that this is a legal requirement, but it is strongly advised that you do so, because there are certain benefits, although it's not that you will have tax benefits or that it's a legal requirement, as I've already said. So it's not necessarily that there are specific benefits to the founder if you do it. However, if you are the founder, you can compile what we call the founder's wish list, and even if this is the only reason really that you do it, you should do it and make sure that you are the founder of the trust, because then you have a better control in terms of where things go together with the trustees, okay? And the trustees, so you have got two types of trustees. One is the ordinary trustees. They control, the trust like directors in a company, so they are accountable. They control what happens in the trust, and these are the most important people in the trust. So the founder you may be a founder and not be a trustee. So, but you need to make sure that you are a founder and both registered as as a trustee, because you want to be interested in terms of how you run, because only the trustees actually really run the trust. It's important that you are a part of that. These are the most important people because they make all the decisions that are happening inside the trust. It's a pity that I'm talking, so I'm trying to use descriptive words as much as possible so that you understand, because you are not looking at the presentation slideshow that way you can just read for yourself. So I'm trying my utmost best to try and use descriptive words for you to understand what I'm saying. So the second level of trustees also is what they call the independent trustee. So this is someone that is independent from you. In other words, it cannot be a person who is related to you. Um, for the reason that they need to be independent, because a trust is not something that you own. Okay, so we need to get that right. It's not something that you own. It's something that is established to be run for the benefit of the beneficiaries. And there are certain laws that need to be followed, and they need to be followed to the T. And the decisions that are made in the trust need to make sure that they are only for the sole benefit of the beneficiaries. And it must not be seen that you are trying to maybe have certain benefits by creating the trust for you to control it solely for your own benefit. So that's why there must be an independent trustee. So it is preferable that you appoint someone who can add value to you. When you put an independent trustee, you appoint that independent trustee, and you can also change them, if you want to do so. So it's better when it's someone who understands trust law or trust accounting. Sometimes people use law attorneys for this, who understand trust law, or trust accountants. They appoint them to be independent trustees because they will add value to you by advising you on how things should be done. They don't make decisions in the trust. They are simply there to just oversee that the trustees are acting in the best interest of the trust and following everything that needs to be done, and also that the decisions that are made by the trustees are for the benefit of the beneficiaries according to what is written in the trust document, in the trust deed. So that's very, very important. But however, I know many people do appoint independent trustees who is just a person who can be a friend. So while that is fine, there's nothing wrong with it legally to do it, but you need to make sure that the independence of that person remains intact. And also that they understand what they are doing, because then if it's just the person who's the same as you, they don't understand certain things, you may then have been found to be doing things wrong and you won't even know it. So it's important that you understand that trustees act jointly. In other words, they act on consensus. There's no voting, to say it's 60% votes, therefore we go this direction. Whatever decision that is made, the trustees must sign on it, in consensus. So it's important that you choose your fellow trustees wisely, and that they will understand the goals of the things that you want to achieve, so that you will not have objections when you want to do certain things, and that it will flow smoothly because everyone is of the same mind and you all understand the same things. Very important, because if you do not agree, then no decision will be made. That decision will not be able to go forward. The third part of the trust is the beneficiaries. So the beneficiary is then anyone who benefits from the trust, and it can really be anyone, so it can be a total stranger or whatever it is that a person is, but they must be named in the trust. But we are talking about providing generational wealth to your heirs, and so the number one choice, it's your family, obviously, including yourself, that you put in there, because if you are in a living trust, that is the one that we're encouraging, because it also continues even when you are dead. We'll talk about that in a little while. So it's the most beneficial in my view, because it serves your purpose as you are alive, and it continues to serve the purpose even when you pass on as well. So beneficiaries must be nominated in the trust deed, as I've said, and it can include also unborn children. Okay, very important to note. So how you name them, because I said they must be named in the trust. So it will simply say the beneficiary, for example, of this trust is Mr. Nkambule, your names, and it will also says and their descendants. So anyone who becomes your descendant, whether it's your direct child, your grandchild, or great, 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 great grandchild, by virtue of that statement, they are named inside that trust. As long as they become your bloodline in terms of that clause, they're covered in there. And that is why, that is the power of this instrument, because it can live on for many generations. Something can stay there for a very long time. Okay. And then also beneficiaries can also be other trusts. So if there is more than one trust, you want to make sure that those trusts are beneficiaries of each other, all of them, so that benefits can pass from this trust to that one and vice versa. And that is very, very important also to do. And you will see that in my advice later on, that we actually advise that you do not only have one trust, but more than one, in order to take care of different risks at different levels as well. So let us look at risk management, because one of the most important things why you are putting a trust in place is actually risk management. You want to manage risk. There is risk that happens with associated with a whole lot of things that we do, and we need to effectively manage these risks. First on the line is personal risks, which can be divorce, it can be damage claims, it can be an accident on the road. These things happen to anyone. So it's important that you prepare for them. You prepare for bad times in good times. It's a very, very important principle, that when things are good, you prepare for the bad time. It's the same as when I started, and I spent a bit of time in terms of talking about putting that challenge out there for everybody to strive to be debt free, because you do that while you have the resources to do it, and you put yourself in a position that when bad time hits you, you remain good, because you have prepared for those times in your good times. So don't be naive and think that certain things happen to certain people. It can happen to anyone. You can look at it today and say, no, that won't happen to me. But trust me, the people that it happens to, they don't choose it either, but it happens to them. Secondly, is trade risks. You can be sued personally for things that you do, maybe in your job as a doctor, and so on and so forth. Human error is possible, so there could be risks associated with your trade. So it's important that you think about that. Thirdly, is business risks. Excuse me. It's a business risks. So in terms of that, that you are responsible for the business, and you shouldn't ever think that your business, no matter what business you are in, that it is immune to risk. Okay, we know that businesses can be very risky to do, and so you think about those risks and make sure that you cover for them. Fourthly is property risks. There is an element of risk that comes with dealing in property. It is risky to deal with tenants, letting agents, sales agents. Something can go wrong in that process, and so you want everything to be covered. And so the list goes on in terms of what risks you can be exposed to. That's why you put trust in place. What are the benefits of the trust? Okay, very important, and I think you should listen to this very carefully, because there are some things that are there and then you're probably not aware of. And each time that I talk to a person or a group of people, there's usually that element of surprise, because people are not aware of some of these things that are there in terms of the law. First of all, the benefit of the trust is that there are no estate duties. Estate duties is things to do with expenses that are associated with death. Okay, so there are duties and there are taxes that are associated with you dying. Okay, because you're gonna die at some point, right? And so how you live your affairs can determine whether the people that you've left behind, your loved one, benefit to the fullest in terms of the work that you've done and things that you've acquired, or somebody else, eats into those benefits. So benefit number one is that you avoid these taxes, okay, that have to do with death, duties and taxes associated with that with that death. So if you have assets that are in your own name, is that there will be huge costs when you die that are associated with those assets. So people think that if they own something and it belongs to them fully and they've paid for it, they don't realize that there's a chance that your children or the people that you've left that piece of asset for, whether it's your house, which you have fully paid for, that they have a risk of actually losing the entire house when you die, even though it's fully paid off, because of the things that kick in when that happens, okay? And depending on what state they are in and being able to carry some of the costs that are associated with that, there's a possibility that they can actually lose the house. Secondly, there are no executor fees. Executor fees are fees associated with people that have been appointed to administer the wrapping up of your estate when you die. They receive about 3.5% of your gross estate. Okay, that's the money that it's a percentage. So the more money that is in your estate, the more they get paid. The level of work is not necessarily associated with the level of income. So, for example, let's say that when you die, your gross asset value is 20 million, for example. So that's the value of the asset. It's not the net value; it's the gross total value of the asset, 20 million. But you owe 40 million rand, to in terms of the bonds and mortgages and so on. So that's what is the situation at the end. The executor will still get their 3.5% and is calculated on the 20 million, although your net asset value is actually 6 million. But you must pay them the total of the 20 million. So they will get 560,000 of the 20 million. All that work for probably doing work that costs between maybe 20,000 rand, 30,000 rand. That's the value of the work that they would have done. But because it's a stipulated amount, it's 3.5%, and that's what they will get. So by having your assets in a trust, you avoid this kind of losses. The third benefit is that there are costs associated with the moving of assets, that you move, because when you die, remember, these assets are registered in your name, especially the houses, because those are the ones that attracts a bigger cost, because there are transfer fees, just as much as you paid transfer fees when you purchase the property. When you die, that property needs to then be transferred to the people that now have survived you, and it costs money to do that. So in total, if you look at all these fees, executive fees and taxes and all sorts of things like that, there's a principle of 1/3 principle, to say, basically it means that on your total personal assets upon your death, you will lose 1/3 of the value of that asset when you die, in costs and taxes, conveyancing costs, taxes and other things. You will lose about 1/3 of that, of the value of that particular property or asset. So this cost, therefore, remember, they must be paid in cash. So now, if you die and you have a house, you simply have a house. It has a certain value. And that's where I came in and said there's a possibility that your children can then lose that house, okay? So, but they must then pay these costs in cash, which they may not have. So for them to be able to then cover this cost, it will then means that your death must trigger the sale of the house. The assets must be sold in order for this cost to be paid. And it means that therefore they lose that particular asset and they will never be able to replace it, because it is sold on the cost of the asset and then minus 1/3, which goes to all the costs, and then they are left with only 2/3. So they will never be able to own the actual asset which you have left for them, because death triggers all sorts of taxes. Okay, so there's a tax liability that comes with death. So using trusts protects you against all these costs, because remember, the trust does not die. Okay, it doesn't die, it lives on. And so there is no trigger for the payment of estate duties and transferring of the assets and so on, because they simply remain in the asset, in the trust. Fourthly, the benefit of a trust is the protection of minors, protection of young children. If you're under 18, you cannot inherit, all the assets. So therefore, the assets are placed under guardianship. Okay, so trust protect minors against this problem, that nothing will be transferred to other guardianship and so on, but they will simply remain in the trust and they can continue to benefit from that. So you safeguard your children from the problem of things having to be placed under a certain guardianship. Okay. The next benefit is continuity. If you die, your property is registered in your own name, your bank, forecloses on the mortgages and wants the properties to be sold off so that they can get their money that they are still owed. Okay. So your property portfolio doesn't continue when you die. So, you would not be passing your legacy to your children. But in the trust environment, continuity remains. Your portfolio of whatever assets you've owned, it continues. Next benefit is succession planning. It can take up to 5 years to wrap up an estate, a death as a deceased estate. It can take that long to wrap it up. And during this time, everything is frozen, accounts, everything. And so people don't have money that they can access. So you can be very rich and leave a lot of money and then face a problem that people live poorly for 5 years because things have not been concluded. And so therefore they have got no access to the money that you have left for them for a period of 5 years, up to 5 years. Okay. Another benefit, as I've said before, is the founder's wish list. You can write a list of your wish list of what you wish to happen with the trust when you die. And so if it's drafted carefully by people who understand trust laws and so on, it will be a document that can stand and not be seen as you trying to control the trust after you are dead. Okay, so those are the things that then help with the transfer of things to the next generation through using of this trust. There's a huge saving and a huge risk that can be there, upon death, because it triggers a whole lot of things. Okay, how are we doing for time, Mr. Gambule? I want to go to our next part of the discussion, which is also very important in terms of how you can structure your trust. And I also don't want to rush it that much, but I think we still have a little bit of time.
Yeah.
So
we still have time.
Are we good? All right. No, excellent. So now I've talked about the importance of the trust. What is a trust? What are the benefits that you get from it? How is it set up, and so on. And so I also mentioned that it's important that also that you don't just do one trust, okay? But that you look at doubling up on certain things. And so we know that bad things happen to good people, and we don't know the reasons why. We often hear about people not making it in the business world. We hear about how they lost everything when the market turned. Now there was COVID. People, lost a lot. There's been a lot of losses that has happened. It happens from all walks of life. It happens to clever people. It happens to stupid people. So if it happens to you, you don't really get hung up on it to say, why me? Just know it happens to people, good or bad. It has happened to famous people like Donald Trump and so on. And they write books now to talk about their experiences. And so they have learned from the experiences that they have seen. But, it's a mistake. Ask yourself sometimes, why could such clever people make such stupid mistakes? But yes, things happen. And the mistake we're talking about is the fact that they put all their eggs in one basket. Okay, we hear this clause, never put your eggs in one basket. It's actually an international saying, and it's a basic rule of life, that we all need to understand. When you put your eggs in one basket, if the basket falls, all your eggs will break. It's as simple as that. So you need to then keep different eggs in different baskets for different reasons, so that if the one basket goes down, all the eggs crash inside that basket, you still have the other basket or the other one to keep. Okay, I think it's a very simple principle that we can understand. So therefore, compartmentalizing is the true and only gospel of investment and business structures. And so it applies to how you should also structure your trust and your life. Try to keep things separate from each other so that if bad things happen, you are safer, and that you can be able to save some of the things and not find yourself having lost everything. So therefore, we talk about separation of assets and liabilities. Assets are things that you own that are positive in your life and they put positive income, and liabilities are things that you owe, are things that take away money from your life, away from your life. So the principle here of separation is that you keep low risk assets in one place or one category. Low risk in one place or category. High risk assets and other liabilities in a different category altogether. Okay, so that is the key. And so in terms of you separating these risks in terms of trust, it is advised that you have at least, depending on what you do in your life, you should at least have 2 trusts as a minimum, okay? And then you can have 3, you can have 4, depending on the other things that you do. The number 1 trust being a family trust, okay? This year we are talking about low risk, and we continue to increase the risk on the other types of trust. So family trust, you want it to be your least risky trusts. In other words, you keep in there things that are the least risky. That means that you paid things that are paid off. You put them in your family trust. Things like your life insurances, things like your car. If it's paid off, you put it in the family trust, and all kinds of items. We talk about furniture, we talk about curtains, we talk about chairs down to the last floor mat. Okay, we talk about jewelry, your watches, your expensive earrings, everything. You can keep all these assets inside this trust. It's things that are paid off and they've got the least amount of risk. You put them there because you don't want to put things inside there which will attract a risk that can cause something else or someone else to come after that family trust because they are looking for their money, which is sitting inside that family trust. So anything that is less risky, you put it inside this basket. So that's basket number 1. Egg basket number 1 is a family trust. Egg basket number 2 is a residence trust, and that's why I said you should have a minimum of 2. This is the place where you put your residence, the place where you stay, you and your children, your family. You put it under this trust, and that will include also if you have an additional home, which is a holiday home, and anything asset or property that is of personal use, you put it in here. Why don't you put it in your family trust? Because a house and a piece of furniture that is paid off don't carry the same amount of risk. Yes, there's still a lower level of risk, but in your residence trust, you probably still owe the bank, some money, and so there is a risk in there. You don't want them when they come for the house, they sell it for less money, and they want more of their money. They then attach your other assets, and then they take everything. So you put it in there. It remains in there. If there's a risk, if it explodes, it explodes inside that basket, and that is it. Even if your house is paid off, you still keep it there because there are still rates and taxes and what. And trust me, some of us know that we owe a lot of Western taxes that we haven't paid. So there's a level of debt there. I hope that's understandable. Next in line can be a company asset trust. If you operate a business and you are using machinery, you can have those machinery sitting in the trust and them separated from your actual business that you run. Okay, there's a good reason for this because that means that if you ever have something that goes wrong in the actual business that you run, let's say you make furniture, all right, you've got machinery that makes furniture. I'll put 2 scenarios. I know the time is running. I may not be able to finish, but it's fine. Let me rather give you in-depth understanding in terms of what I'm talking about for each category. We can have another discussion another time if we have an opportunity. So you have a company which you are running, you are making furniture, you've got equipment and so on that you use to make that. Something goes wrong, you bought material, you were not able to pay because COVID hit you, all right? And as a result, you've lost some customers and you're not able to then service or pay that person or where you bought material from. You can't really return the material because the rain came and blah, 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 whatever happened, right? So now they come looking for their money. You don't have it. What do? They want to close you down and liquidate you, right? When they liquidate you, they sell everything in there, including your machinery and so on, to recover their money that you owe them. There's your business gone together with this equipment. It's going to take you a long time to recover and get another equipment. Here's another scenario. You own this workshop, there's equipment in there, you're operating full force, same issue happens, bam. They come to liquidate the company. And guess what? When they get there, they find that all the equipment that you are using, it's inside a trust. And so it's not accessible to them. They can liquidate, take other stock and whatever and move away. But guess what? Tomorrow, as soon as COVID's finished, you simply move across the road, you rent another apartment factory in there, you take all that machinery, you move there, you buy material, and you keep your customers and the business goes on. I'm sure it's very, very clear and be within your mind what the difference is in those 2 scenarios and how the other one is protected and the other one is completely open. The other one is a shared trust. So when you have a shared trust, when you own your businesses, you make sure that you don't own your businesses as a shareholder in your personal capacity, but that it's in your shared trust. Everything goes through there. And all these trusts become beneficiaries of each other so that money can flow across them. I hope it makes sense, the principle of compartmentalizing. Of course, then there are other things that are extremely high risk, like refinance trust and other things, and obviously businesses and so on. They are risky. And so it's important that you have at least two trusts, which will be your family trust and your resident trust, and then the other trust as you continue to grow and to operate other things. Okay. Let's look at taxation. Mr. Gambule, you will let me know when I need to stop, because I still have a lot to say, but if I need to stop, we'll stop. Don't worry about whether I have covered everything or not. I think we've already learned a lot as it is now. And if there's enough appetite, the listeners will then go and research further on this topic, and it will help them greatly. But for the next few minutes that we have, I will just talk on the taxation of trusts. So trusts are taxed obviously differently from an individual, but they are a great asset and tool that is the best for tax planning. And not that you will be exempt from paying tax, of course, but it is certainly the most efficient vehicle for you to pay tax in. But you would realize also when you research, and then that's when you may say, but why did he say that is the most efficient way? It seems to be the most, having the most rate in terms of percentage payment for tax. The reason that it is like that is that, income tax is basically the biggest objection to trusts in terms of the law. They want to discourage people from using trust. So you'll understand that in South Africa in 2017, for example, of course, there are updated figures. These are just numbers. You can check latest one. Tax happened on a sliding scale from starting at 18%, going up to 45%. The more you earn, the more you get taxed, of course. 45%, that's a lot of money. A trust pays directly 45% from the first cent. Okay, there's no sliding. It's a very, very high percentage of tax, whereas a business could be paying about 28% or 30%. So it's a big difference. It's because they want to discourage people from using trust. But those who understand trust and trust laws and trust accounting still know that this is the most efficient way for tax planning purposes, including the reasons that I've already given you in the start. And so an individual, therefore, according to this, can be in a better tax position, and therefore they want to detract, from the use of trust. But at the end of the day, the trust still remains the most efficient vehicle for tax planning. There is capital gains tax. Sometimes most people believe that you only pay capital gains tax on the profit that you make on the sale of an asset, and this is far from the truth. Couldn't be far from the truth, because there are instances in the capital gains tax of certain countries, such as death. When you die, that triggers capital gains tax. When you die, and a big percentage of that total assets value in the deceased estate is payable to the government as capital gains tax. So in other words, what this means is the example that I made, that you own a house, you fully paid for it, and then you die, and then your children must inherit it. There's cash that must be paid. So first the transfer cost and all of that stuff. Then they also charge the capital gains tax. In other words, they will estimate what the value of that house should be, and then charge you capital gains tax on that. And for you to pay that, you need to pay in cash. And therefore, if the cash is not there, that house will be sold, because the government wants their money. So the painful thing is that you haven't sold anything; you just died. But just by your dying, you then trigger, these taxes that must then be paid from your estate. If, however, the asset is in the trust, of course, that's not applicable, because the trust does not die. Okay. If, however, obviously the trust, if it sells the asset at any point, it will be subjected to the official rate of the capital gains tax, which may be higher, than what an individual will pay. But in the overall, when you administer your things carefully and you know what you are doing and for what purpose, it still saves you a great deal of that. Then there is donation taxes. Individual can have a certain amount of tax-free money that they can donate. and so on and so forth. You can go and read up on these things. Because of time, I won't go into the detail, but just for you to be aware that there is a donations taxes as well that gets to be applicable. So now, this is the other real benefit in terms of you having a living trust, and is this thing called the conduit principle. It's called the conduit principle. It's a bit long to explain, but maybe I will try for the next 5 minutes or so to just explain this. And it works in this way, that if a trust makes a profit, and if it retains that profit, okay, it will pay the full income tax rate of 45%. So if the trust has the profit, is made profit, it keeps the profit, doesn't distribute it. It must pay the full amount of 45% tax. And this is where the conduit principle really comes in to benefit you. It's not a principle that is well known by ordinary accountants. You need well-trained trust accountants to apply this thing correctly and make sure that you can benefit from it. So according to this principle, it's that the taxable income of a trust can be legally distributed to a beneficiary of the trust, and it will then be taxed in the hands of the beneficiary that is receiving it. Instead of you paying the 45% of the profit in the trust, in other words, you distribute this money to the beneficiary. They will then pay the applicable tax according to an income of an individual in their relative tax brackets. Sometimes it can be a bit confusing, but just try to stay with me. So they will pay at the tax rate that is applicable to them according to their tax income bracket. So the income can even be split between different beneficiaries, and then each portion is taxed at different rates of the individuals that are receiving the money, okay? And minor children can also be registered as taxpayers, and therefore the effective tax paid on the full income is very little, if any. Why is that so when you distribute? Because depending on the person who's receiving that distribution, if it's a minor child, for example, the tax rate is much lower. So in South Africa, for example, the first 75,000 rand that a person gets paid, all right, in a year, it's tax-free. You can't tax a person that earns 5,000 rand a month, for example, because the first 75,000 rand is tax-free. And by splitting the income, therefore, to different beneficiaries who are in a lower income bracket, then saves on a huge amount of tax that would be paying. I hope it makes sense. So you've got different beneficiaries in there who then receive this money at a lower tax rate. Instead of paying the 45% as profit inside the trust, you distribute this money to these beneficiaries. The effective tax rate that is paid is then very little. Okay, and the beauty of this is that you can do all of this, through book entries, through accounting. Okay, and the money never have to leave the trust. Okay, it's complicated stuff for people who are not accountants, but I'm just wanting you to learn the principles, and maybe that's why many of us then actually use this, because it does require a little bit of competence and you using the correct things to do it properly. The other one, which is a very, very good benefit of the conduit system, is what you could call the sunshine trust or a conduit system. I just want to show you how differently you can apply it as well. Okay, so you can use the conduit system, for example, to help somebody else who is not employed. Remember, it's about the tax bracket that they fall in, okay? So you can have somebody who is unemployed in return for their tax status in order to save tax in a trust, for example. And of course, you don't want to bring very distant people to be part of the trust, because remember, only a person who is named in the trust can benefit. But naming them doesn't mean that their name has to be written. You can simply say siblings of so and so, and so on and so forth. And then the other important aspect that I didn't mention is that the trust, even the living trust, can also be a discretionary trust. In other words, the distribution of the benefits of the trust are done on discretion of the trustees. So the fact that a person is named in the trust deed as a beneficiary does not automatically mean that they will benefit from the trust, if it makes sense what I'm saying. So it is in law written like that it is by discretion. So in other words, the trustees at any point in time can have a meeting and sit and decide how they will distribute some of the benefits in that month or year or period or whatever the case may be. They do not have, not obliged, they don't have to. It's not a right that the fact that you are named in that trust, you will then receive those benefits. I hope that makes sense. That is the beauty of these things and how you can apply some of these principles. So this is how it would work in this case, that you want to save tax by helping someone else, right? Say that you've now distributed to your children and everybody the 75,000 or whatever else as much as possible to reduce the tax rates. And remember, the money doesn't leave the trust. You just do book entries and accounting, okay? The money still remains in the trust. It's distributed, but it still stays there. You still remain with a problem because after you've distributed it, you are still left with 73,000 rand of taxable amount, which will be taxed at 45%, okay, if it remains in the trust undistributed. And that will be 32,850, 45% of 73,000 rand. That is payable to the taxman. That is painful, right? And so you go and you look around, you say you found out that Joe, cousin, the grandson of my grandfather's brother, that's how far the person is, okay? Lost his job about a year ago and is still unemployed. So you meet with him and you say, Joe, look here, I want to assist you with a little bit of cash flow, and then I'm going to help you with 7,000 rand, and in return, I would also like you to do something for me. He says, why do you want me to help you? Say, because of course you are family, and also because of course a family helps each other. So I'm going to help you with 7,000 rand, and in exchange, you give me your tax status, okay, in a nutshell. So that means that when he agrees, you will then pay Joe 7,000 rand, okay, in exchange for the tax status, where you then distribute the rest of the other money to Joe and then pay effectively no tax. So instead of paying 32,850 to the taxman, you will pay Joe 7,000 rand and save the balance. Okay, so you would have saved 25,850 by helping someone else. You save that money from the taxman, and then the rest of the money remains in the trust. I hope it makes sense. So that's the beauty of it. And then let me just wrap it up now, because maybe many of you are sitting there thinking, this is what is it not cheating and whatever? Aren't you getting into trouble into this? Because the reason that I'm talking about it freely on air is because it's completely legal. Okay, there's nothing illegal about it. You must apply this according to the applicable laws and make sure that the accounting is done correctly and that the books can be scrutinized and there will be no fault that is found. And here is this statement of a case that took place in 1936. It was the Internal Revenue Commission versus the Duke of Westminster Minster in 1936. And this is what this Duke said. It was pertaining the issues of tax, okay? So he said, every man is entitled, if he can, to order his affairs so that the tax attaching under appropriate acts is less than it would otherwise be. If he succeeds in ordering them so as to secure this result, then, however unappreciative the Commissioner of Inland Revenue or his fellow taxpayers may be of his ingenuity, he cannot be compelled to pay increased taxes. So this is the authority that a taxpayer may arrange his affairs in such a way that he pays the least possible amount of tax, provided that you do not act unlawfully, okay? And this case is still cited by the courts today. The RC versus the Duke of Westminster 1936 is still cited in the courts, because remember, when cases are done and judgments are made, they become precedent in terms of what happens and other judgments happen in future. So this just proves that tax avoidance is a skill and tax evasion is a crime. So if you evade the tax, they will put you in jail or fine you, or whatever the case may be. But if you avoid tax using the applicable laws and the systems and instruments that are available to you, then it's simply a skill that you use to make sure that you keep the benefits in your family and for your own benefits as much as you can. Just by doing a simple thing of having a trust in place, you already save yourself from 1/3 of money that you would pay to costs and to the government and so on, just by making sure that your assets are passed on to the next generation as you would want to. But remaining ignorant of these facts is very, very costly, to your effort and your sweat that you have put down with the intention of passing things to your heirs, and only to find that there's a big, devastating, and disappointing thing that your children can be kicked out of their own house after you die and they have nothing left. I think with those words, I would say thank you, and then we can end the session or the discussion at this point. And if there are any questions, we can take them. Thank you very much, Mr. Kambule. Over to you.
Mr. Mabuza, this was really a mouthful. I think I wish this was video. You'd see my notes. There's quite a lot of information that you've shared.
Yeah.
And I also have a few questions that came in from our listeners. There's just one observation that I have here. Some people may say these business of trusts are for the wealthy. What
Yeah.
about me? I just have an 8 to 5 job, an ordinary job. Would this be a venture that would also be applicable to me as well?
The answer is absolutely. Remember, a trust is not a business. A trust, let's get that very clearly. The trust is not a business. Yes, wealthy people use it because they recognize its value. But any common man or person should use it as well, because the things that I spoke about, especially when you die, they hit the most also on the common person, who just has as long as you have a job, you've bought a house, you bought a car. When you die, you want those things to be passed on to the people that you love in their entirety and in whole, and you don't want them to lose anything. So it costs you very, very little to put together or set up a trust and to administrate it over that period, and make sure that the things that you buy are inside the trust. It's a very, very simple thing to do, but it's just to make sure that it is administrated by people who know what is going on and so on. But it's not a complicated thing to do, and it is absolutely for everyone, because there's no you can't say that it's for the rich person, then you are prepared to lose a third of what you worked for when you finally pass on and your things need to be passed on to your children. Or you want to take the risk that actually your children may become destitute when you die, because they don't have to cost. Because remember, those costs are applicable to you. Any person who is working is alive. You've got a piece of asset anyway. The things that I spoke about are applicable to you. Those taxes will hit hard on you, the most actually. So it is advised that you do it. It's not just for the wealthy; it's for everyone, because it's a tool that helps you to preserve your wealth in your family and to make sure that it is passed on to the next generation correctly.
Now, Mr.
I hope I have answered that. Yeah.
Yes, you have. There's a precedent now set by financiers that whenever they give you, whether it's a personal loan, a mortgage, or car loan, or whatever, there's life insurance attached to that to safeguard that should you die, that asset does not get repossessed, but it gets to the beneficiaries that you have nominated. Now, my question would be, do I have to wait for my assets to be fully paid off for me to set up a trust, or I can actually do it at any time?
Yeah, you can do it anytime. In fact, the advice is that you do it anytime. That the first time that you purchase that house, that it is registered in the name of the trust from day one, because you simply buy the house, and then in terms the trust actually purchases the house, and you become the what do you call it? The one who guarantees the payment for the monthly installment. In other words, you then are lending money to the trust to be able to pay the installments. Okay, so from the day that you purchase that house, you register it in the name of the trust from day one. You can do that. Yeah, you don't have to wait until it is paid off. Yeah. And yes, the issue of the insurance is to pay off if something goes wrong should you die is a very, very good one. It's something that everybody should make sure they consider. And if it's a mandatory thing that is done by the bank, then it's a great thing, because it does protect you a great deal as well. But remember, any life insurance that you take also limits the other life insurances that you could take, which can then be distributed directly to the people that you love upon your death. So in other words, your income, there's a certain limit of how much life insurance you can have. So if the other life insurance is tied up inside the house, just for the sake that when you die they want their money. But of course, if it's mandatory, then you don't have a choice because you're taking a loan, you would have to pay it. But if it is not, you would rather take then a bigger life insurance, that will give you maximum outside of the asset, and then put your asset in the trust that protects you from it having to be sold and to pay the additional cost and so on. And then you still maximize on your full life insurance outside of that, which will then be the maximum that you are allowed to do according to the income that you are getting. Then in that way, you ensure that there is a bigger benefit for your beneficiaries.
Now, you did speak about this, but it's coming up here again from our listeners. Maybe if you can just go back a bit, the part where there are some tax elements that would be incurred by my beneficiaries if I die when converting my estates to the names of the beneficiaries.
Yeah. So I said that what happens? So your death triggers a couple of things. First is that obviously when you die, you becomes a estate. Okay. So in other words, things that you own personally, they become part of that estate. They need to then freeze everything that you own in that estate, and then after that, appoint people to administer that estate. In other words, they are going to look at whether you left a will when you died, and what did you say in that will, where things must go to. And if you have left a will, it makes things easier in that they can then the process can progress much faster, in that the things can then be distributed to the people that you said must be distributed to. But the executor still needs to be appointed, and there are costs associated with that. And in you passing on those things to the people, if there is a house, for example, the house, by it having to be transferred from your name, the person who has died, to your child who must now, or your wife, or whoever, even if you are married in community of property and you owned 50% of, or you own the house jointly, when one party died, that asset needs to then be transferred to only the name of the surviving person. Okay. It's not automatic to say when you die, they just say, okay, now the other person owns it. No. In the deed document, it specifies your name in there. So your name has to be removed, and your part of the house be transferred to the other person who is surviving. And it costs money to do that. Okay. So those are the monies that are associated with this. On top of that, there will then be taxes that need to be paid on that, to say, if there's capital gains tax because you die, the government then demands to say what is the portion of their tax that you must pay them. And this money must be paid in cash. And remember, the house is not sold. Okay. You haven't sold the house, but these costs are real. They need to be paid in cash. So if you find that the people that you left behind don't have the money to pay for these things, this house therefore needs to be sold, because those costs still need to be covered. Does it make sense? So you see, you have to sell the asset so that you can then cover the costs that are associated with your death. That is the most painful part. That is the biggest cost, where they go to, and where it's estimated that it can be up to a third of your estate will then go into this kind of costs. And it's worse when you don't leave a will, because then it goes to lawyers and all sorts of things, and the family will fight, and what it needs to go to court, and all those things, they cost more money, because then, and it takes long. That's when it can go up to 5 years to wrap up these things. And in the meantime, people cannot benefit from those things because it's not been finalized. It will only be distributed upon finalization.
Now, Mr. Mabuza, what keeps the trust liquid? Where would the money come from to actually make sure that the trust stays longer than the generations and generations to come?
Yeah. Okay. So the good thing, that's why it will depend on which trust it is, and what it's meant to do. Remember, I spoke about the different trusts. I spoke about the family trust, where you put things that don't that have got the least amount of risk, and then you've got your residence trust, and so on and so forth. So how much money goes in there depends on which type of trust it is. So in your family trust, for example, if you've got paid off cars and whatever, it will cost the money to pay. If you have accountants, because you must have accountants that you administer, for them to do the books at the end of the year and that sort of things. So that's the money that will have to be there. So nothing will just happen without any money, being there. There has to be that come from that you also pay a larger and to is anyone living life, there are expenses that are associated with this, but those expenses are at an absolute minimal compared to what could happen if you don't have it. It's very, very small cost. You can think yourself, if you need an accountant to just do some books at the end of the year on a trust that doesn't have too many transactions, it will be just a few lines, and then they charge you that 2,000 rand or whatever the case may be, and then put your books together and submit and make sure that the tax status is always up to date with the authorities. So it's not a lot of money that is required for you to keep it alive.
Now I think we spoke about this on the previous sessions, where the unfortunate happens that one dies and you leave a will, and some of the assets are transferred to your children. 6 months down the line, they have squandered on their inheritance. Would you say that
Yeah.
a trust can safeguard against abuse?
Yes, absolutely. Because when you die, and you have got your things in your personal name, it triggers the taxes and whatever else and the distribution of those assets, right? So that we understand. When you die and you have trust in place, it triggers only one thing: the replacement of a trustee. Okay? So understand that. Remember, we said that be careful the people that you choose as fellow trustees to administer the trust with you. So you already have trusted people that are there to administer the trust, and they are the ones who decide which benefits goes to who. All right. So when you die, you put in your will who must replace you as a trustee, and it's obviously a person that you trust very well. So when you die, you simply move out. The trust remains intact. Everything that is there still continues to work as is. Only a new trustee comes in there, and their assets remains the same, and they continue to manage those assets on behalf of the beneficiaries. So the beneficiaries can't touch those things. They will simply continue to get the benefits as you have intended.
Just one last question before we wrap up the session.
Yeah.
What criteria should one follow when nominating trustees?
It must be people that you trust. That's why this thing is a trust. It's based on trust. Yeah, it's then administered in terms of the law at a very high level, because it's a trust that is enforced, kind of. But yes, you must then nominate people that you trust very, very well, because you are trusting those people with things that have to do with everything that you work for and everything to do with your children and your family. So you need to make sure that these people, preferably, if you are a family, so your husband and wife, you both become trustees in there. If you so wish, it should be the first thing that you do, because you are both doing these things together for the benefit of your children and everyone else. And then, but yes, you could be a single person. You can have a trusted friend, or any person like that you can then. But unfortunately, you will not be able to control the actions of those people when you are dead. So yeah, it's a matter of trust. That's what it boils down to.
Before we wrap up, Mr. Mabuza, there's this controversial issue of debt.
Yeah.
I'd really appreciate if we can go back there, just to warn our listeners in terms of this lifestyle of debt. You find that I was earning 700 Malangeni and I was able to leave, but now I am earning 7,000 emalangene, and automatically the lifestyle just goes up. I can no longer eat maybe a takeaway from the street. I now have to eat at Woolies. All those things. What can you warn our listeners in terms of handling their finances and avoiding debt as much as they can?
Yeah. So my advice to everybody is to actually get out of debt completely. Yeah. So I'll put that ultimate goal up there and not just say reduce it. Of course, to get there, you must reduce it slowly until you get there, but get out of it completely. And the things that we do are usually motivated by things that are not that important, because usually the reason that people get a better paying job or whatever, and then all of a sudden there's a big change of lifestyle, they're driving a bigger car, it's motivated by what the society will say or your friends will say. That is the perception, because you want to be seen to be driving a bigger car and owning a bigger house, etc., etc. That is the only motivation. And you usually find that you buy a new car today, and or not even 6 months, 6 months is too long. After your friends have seen it 2 or 3 times, it's just another car on the street. We know that you own it, so what? And if you improve your income and never buy a new car, we don't know that you could have had a new car. And so we don't really care. If I'm your friend, for real, I'm your friend because I'm your friend. I don't care what you own or don't own. And so you could use that money more effectively, for yourself and guard yourself against the tragedies that you can find yourself in. And also, I don't have to really hammer much on that because we are in lockdowns as we speak now. Most people have experienced some level of hardship because of the situation that has happened. And this is a classic example of something that happened that nobody expected, except maybe a few. Well, I won't go into that. It becomes political and otherwise. But nobody knew what was going to happen, that something like this would hit you. You could be doing well today and tomorrow your business is down the drain. And so you need to then guard yourself against such things. And it can happen on the global scale, like it happened. It can also happen just to you individually. Something can happen which just happens to you. You can have an accident or whatever else that causes you to be out of work for a prolonged period of time, and then you get retrenched or whatever the case may be. You can have a personal tragedy that causes you to lose a lot of things. And so I encourage people to say, rather use your money wise. Keep more money in your pocket, than you spend as much as possible. I don't really have to go on and on. We are all experiencing it. If you haven't learned anything out of this situation, then you will never learn. Yeah.
So we can safely say, well, gospel according to Eric Mabuza, there's no good
Debt free.
debt. Debt
No.
is
Well,
as bad as it can get.
yeah, well, yeah. We won't say there's no good debt. I'm saying get out of personal debt. Let me put it that way. The
Okay.
other debt, which may be good, which you want to use to improve yourself, apply the principles and the instruments which I've taught you today to handle that debt. So that if something happens, compartmentalize. A bomb must explode in one place and not destroy your entire house. That is the true gospel. Okay.
Okay.
Take away your personal debt and make sure that you are completely risk free. And then the things that you do, use the instruments that we have taught you today to manage it. If something bad happens, you don't care.
Mm, mm.
As frankly as that. Yeah.
Mr. Mabuza, thank you very much for the lovely session that we have had. And we thank you for accepting our invitation. It honestly has been a good way to end off what we had planned for the month. Thank you for your time, and please pass our regards to Sisimpumi and the kids.
Absolutely. Thank you very much. I appreciate the time that you've been given, and it's been an absolute pleasure to share some knowledge. I hope people have learned something and there's a good takeaway for them. Thank you very much.